Look at the inflation that we have in this economy. You look at what Harris and Biden have done, and they've really squandered this opportunity. And I am of the belief, Rob, that, certainly over the long term, and you can't time the market, I get it, but that's where that appreciation is going to come from. That's going to help you keep up with things like inflation. And you look at the market over the last, even with Kamala Harris and Joe Biden in the seats, right? The market still did well. It's innovation.
Yep. And, right now, when we look at markets more broadly, we're in this situation. The S&P had a bit of a difficult week this week, trading off a few percentage points, various reasons. But, today we had that jobs report, and it's like this tug of war between, is bad news good news or bad news? Obviously a weakening economy and declining employment that's signaling like maybe the economy is not in strong shape and we're, at risk of. The other hand, this is what triggers interest rate cuts. Cuts are very favorable for equity investors. They're favorable for almost investors in.
So if you own stocks, translation for, folks out there who are just getting started. No, I mean, the equity market, the stock market, right, has benefited from these lower interest rates. It's so fascinating because the Fed is like trying to do the right thing, right? They're like, okay, we need to make life easier for everyone, especially the middle class. And yet what happens, Rob? Life gets harder for the middle class, and asset prices keep going up. So who does it benefit? Everybody on top. And then as long as, they're willing to give you enough handouts and let them eat cake, Kamala Harris or Nancy Pelosi, we're going to give you this, we're going to give you that. On the bottom, those people are taken care of, but those people in the middle, they're the ones feeling the pain, especially if they're not invested.
Yep. So, when the way I'm sort of looking at the market right now in the context of this struggle, between recession versus interest rate cuts, what could happen is, you have the Fed is very sensitive to the jobs situation, right? You don't want spiking unemployment, and it has a dual mandate. And I think the reality is inflation could be neglected as the Fed, kind of makes sure that we've got full employment. And that might translate to tolerating higher levels of inflation. There, by bringing interest rates down to a level that supports that higher level of employment. So that is actually like it might not be a good recipe for stopping inflation, but it is a recipe for, helping stocks and, some sectors more than others. But, if you have low rates and, you have a supportive Fed that's sort of buttressing the economy, you could kind of sustain rising earnings, but lower rates bringing down the cost of capital, helping with multiples on earnings multiples.
Mm-hmm. It should be, in other words, it should be one of those things that kind of gives a little bit of wind in the sail, so to speak, to the stock market when the Fed starts this rate cutting venture, which I think, given today's jobs report, 142,000 jobs being added to the economy in the month of August. We saw revisions for June. We saw revisions for July, all revised lower. This comes on the heels of them revising the big revision, right, that came out for the whole year. And I just say, I don't think it's enough. I don't think 142,000 jobs is enough to really fuel job growth in this economy. Now, I mean, I hope I'm wrong. Listen, I mean, the one thing I want is for the economy to do great and to soar and for all of this to work out splendidly. It's in all our interest for that to happen. But 142,000, I'm not buying it.
Yeah, and I think, Jerome Powell, he expressed himself the other, a few days ago, 2 weeks ago at Jackson Hole. They've got eyes on this, and they see really a deteriorating employment picture. One of the interesting things I picked up from one of the Fed banks, some economic research that they put out, we've really burnt through, the economy really, and this is part of the reason we had inflation, is we had all of the stimulus money, which kind of filled up the coffers of consumers, at the time, and they've burned through it. And now they're, in debt, and credit card delinquencies are going up. So that savings is being burned through. It already caused the inflation. The inflation itself is sort of a challenge for consumers, as are high interest rates. And now we're looking at really kind of an economy that after a few years of this, the consumer is kind of running out of steam, and we're starting to see job losses, and the Fed is pivoting. And a lot of people are saying, look, there's genuine recession risk here. So when I
No,
look
I
at
mean,
this,
that's actually really important, like that recession risk, and it's dicey, right? Because you're going into an election season, so they don't even want to hear R when it's not an election season, the R word, so to speak. But I think recession risk is a fair thing to put on the table right now. Again, I'd have to see some more by way of consumer spending numbers. But, you know, if you continue, inflation has come down a little bit. And when I say it's come down, by the way, guys, like it hasn't really come down because it's all cumulative, right? So if you're just no longer up at 9%, which is where it was driven in the initial year, the first year of this administration, it's down, but you're at 2.9%, and that's on the heels of what you were the month before and the month before that.